This is an update for the S&P 500, and I'm also going to be taking a look at the macro data. Before I start this video, please remember that I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. Now, looking at the S&P 500, it's quite clear to me that ever since the governments and central banks embarked upon their new Keynesian economics policies of zero interest rates and money printing, the gradient of the S&P 500 clearly steepened. And then after the COVID period, when the government's decisions and policies led to this surge in inflation and also surge in the S&P 500, we seem to be actually trapped inside this asymmetric triangle technical pattern. Now, broadly speaking, a lot of market commentators are talking about the Fed's being able to drop interest rates, and then that could then create the blast off out of this technical trading pattern to the positive. Also, if you follow some commentators, particularly the gold bugs and people like that, there's people talking about imminent currency collapse, which could perhaps provide a downside. So this is my dashboard where we see how the central bank uses its new Keynesian economics to meet the central bank targets, which are inflation being at 2%, GDP growth being at 2%, and low unemployment, with the stock markets and house prices being kind of like secret secondary objectives. So starting with inflation, and it's definitely been trending lower. We just had a 0% month-on-month CPI print for the month of October, and this actually saw the S&P rallying hard this week because obviously the low inflation leads to speculation that they may be able to start lowering interest rates. Now, myself, I don't like using these year-on-year numbers. I find month-on-month CPI increases much more useful. I think that's better data for what's going on now. And we can see that the trend really is improving. And actually, this is only 1 month's data out of 3, but we would actually be on target right now and back to normal. So actually, inflation is appearing to be on target now, although it's only 1 month's data, and we have to worry about the trend if that was to continue. GDP growth, and currently the blue chip consensus is between 0 and 2%, with the GDP now numbers being at about 2%. So this is extremely healthy GDP numbers, but we have to be a bit cautious at how massive the Q3 print was. But clearly GDP growth is extremely strong still in the US and actually way above target. Unemployment remains extremely low in the US, as it has been throughout the last 4 or 5 years. And obviously the stock markets and house prices are doing great. So as much as I hate to say it, first impressions here are that Jerome Powell could have pulled off a blinder here. We have inflation in target and really good GDP growth. My general feeling around this is that actually the GDP growth is a bit too high, but that could well balance off the trends with inflation. So whilst I definitely don't see the Fed cutting rates anytime soon, it certainly doesn't look like they'll be raising them, and things look really good actually from this perspective. The way I make sense of this is that the US has the advantage over the rest of the world in that, as well as having the reserve currency, the US is one of the world's most important exporters of hydrocarbons. It's extremely hydrocarbon rich. Plus, it has all of the most advanced tech stocks that give it a globalized advantage over the rest of the world. No one else's economy enjoys the monopoly that the American economy enjoys in terms of its tech stocks. Now, of course, all of this is only possible because of the strength of the US dollar. And so it's important to also take account of this. Interestingly, the US dollar fell sharply this week because of the low inflation news. But overall, when I look at the long-term trend, actually the US dollar's only strengthened since COVID began, and it looks to be standing up very well within this reasonable time frame. But then we need to also consider yield curves, and the US yield curve has been inverted for a long period of time. This is the Japanese yield curve, which is what, according to the experts, yield curves are supposed to look like. And the US yield curve has been inverted for a long time now. We see, however, that in the last few months, it actually flattened. However, I don't think that's necessarily a good kind of flattening, because the method by which it flattened wasn't the short end going down, but was by the long end going up. So now the US government has to pay higher interest on its long-term debt to the tune of about 5%. Interestingly, after this week's low inflation numbers, the interest rates actually reduced a bit on the yield curve, as you can see if you compare the green line there with the blue line. But really, we have to accept that when we look at the yield curve here, it it does suggest a lot of uncertainty in terms of the US dollar. Another thing to think about is the Japanese yield curve, because for many, many years, they've been actually using taxpayer money to buy bonds at the 10-year to keep them at a ceiling of 0.5%. And in October, they raised that to 1%. And you can see here the jump from 5 to 1% as soon as they did that. And they actually recently announced that they're going to stop this ceiling. But as they put it, we will intervene where we have to. So there's a real sea change there, in that the Japanese are no longer burning loads and loads of taxpayer money to artificially maintain the Japanese yield curve. And this is something that's been known as the carry trade. But you have to wonder, is this perhaps a attack vector on the US dollar that could emerge? So one thing that influences the yield curves is the confidence that the global market has in the US dollar. And the two things I've been monitoring regarding that is government debt and fiscal deficit. Now, these numbers look absolutely horrendous actually at first sight. The government debt is 120% of GDP, and the fiscal deficit, so that's the shortfall between the taxes the government gets and what it spends, is 8% of the entire country's GDP every year. So these really do look like horrific numbers. And then when you look at them graphically, how much more debt the US has got in over the last 5 years, that looks horrendous, as does here the budget deficit. And you see that here, this is this is the fiscal year 2023. You can see here the income that the US government got, and this is what they've been spending. There's here a massive deficit of $1.7 trillion a year. So this does look really horrendous. But then when I compare it with 2019, actually it's not that much more. And I've seen a lot of people going on about how just the interest on their debt is starting to get out of control. But it's actually only increased from 8% to 11% of outlays. When I did a graph of the US fiscal deficit as a percentage of GDP, we see that although, since COVID, there was a seismic jump from 100% of GDP to 120%, the actual trend looks kind of stable. And the same for the fiscal deficit, which obviously this is how it perhaps should be looking. And okay, it's looking a lot worse, but it does have a kind of stable appearance about it. And then when I looked at the budget deficit, it's not actually that bad compared with what it was in 2019. So what I feel about the fiscal indiscipline of the US is it can get away with it because it has this economic chokehold over the whole world with the US dollar as the world reserve currency, and it can get away with this behavior. And although these numbers do look bad, I feel like they're taking the Michael to the greatest extent they possibly can. But I don't think that the US dollar is going to break down just yet when I take a more comparative look at it. And also, you've got to realize that as well as the raw macro numbers and the currency consideration, there are also lots of deflationary forces which have also enabled the new Keynesian economics model. Most importantly of that was the growth of the internet and technology, and also globalization. Now, we do worry about things like globalization fading away as a force, but on the inflationary side, whereas a couple of years ago we had all rocket boosters blasting here, currently the inflationary forces have faded as well. So this whole thing does seem to be kind of in balance. So the sea currents that affect the government's behaviour do seem to be in balance at the moment. But you've got to bear in mind that there are risks there on the kind of international level which could sway things, which could change the currents one way or the other. Just so that I don't leave it out, the central banks continuing with very modest quantitative tightening. So there's no real kind of net influence from that at the moment. So in summary, according to the raw data, there's, and I really hate to say this, but there is every reason to believe that Jerome Powell may have pulled off a blinder here. We could see a continually strong economy in the US with modest inflation. And so that could see a real blast off north of this technical pattern. However, there are also serious risks involving the US dollar. But my gut feeling is that they probably have got away with it this time. Now, of course, although things have been so exciting in the last few weeks, we could still stay within this trend for at least 6 to 8 months before we finally break out of it. My portfolio is currently very defensive with no S&P exposure, but I do feel like if we do break out of this technical pattern, I think I will be investing, say, at least 10% of my portfolio into the S&P 500. But I do feel it quite likely that we'll stay within here for quite some time, and that will give me more time to collate better data, because you've got to accept that there are some downside risks as well. So I plan to hold my powder dry as long as we stay within this technical trend. Please remember that I do these videos just for fun as a personal hobby. So always speak to a professional financial advisor before making any investment decision. I hope you enjoyed this video and speak to you at the next one. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. You'd be really stupid to make any kind of investment decision based on this video. Always consult a qualified financial advisor before making any investment decision. Prices can go down as well as up.